Friends, now I am telling about journal basics to make journal entries easy. Now I am explaining about journal meaning. Journal is a record that keeps accounting transactions in chronological order. That means as they occur, and also it includes with details of the accounting debited and credited and the amount of each transaction. It is often defined as book of original entry. To record a transaction, accounting system uses double entry accounting, which means transactions are recorded using two sides. That means debit and credit. Golden rules of debit and credit. These are the basic rules to be followed. Real account. In case of real account, debit what comes in and credit what goes out. Personal account. Debit the receiver, credit the giver. Nominal account. Debit all expenses and losses we incurred and credit all incomes and gains we earned. Usage of debit and credit. Now I explain how to use debit and credit easily. In case of change in assets and expenses or losses, assets account. In this account, whenever there is an increase, we should debit an account, and whenever there is a decrease, we should credit assets account. Similarly, expenses and losses account. In this case, whenever there is an increase in expense, we should debit the expenses account. Whenever there is decrease in credit the account. Of liabilities and capital and revenue. You see, in case of liabilities, it is exactly different from the previous slide. In this case, increases will be credited and decreases will be debited, as well as capital account. In this case, decrease in capital is debited and increase in capital is credited. Similarly, revenue or gains account. Now I show how general balances in accounts. Debit balance accounts. In these, assets account, expenses account, and dividend account. These are the general debit balance accounts and credit balance accounts. Liabilities, revenue, and equity. I am showing that these are the general balances available, but these are not frequent. Sometimes there may be changes. How to analyze transactions? What is being exchanged is first analyzed, and then what accounts are affected, like liabilities, assets, capital. Which of the account is increasing or decreasing? Are the amounts debits or credits? Finally we have to analyze. Examples of accounts. Balance sheet accounts. Assets. Cash, accounts receivable, equipment, inventory, prepaid expenses. Liabilities. Accounts payable, accrued expenses, notes payable, unearned revenue, deferred taxes. And finally, warrants equity. Capital accounts, retained earnings. Statement accounts. Expenses or losses. Salaries, selling expenses, depreciation, rent, interest expenses. Revenue or gains. In this case, revenue is primarily concerned. Now I take an example to explain the entire concept. Naveen purchased a laptop for $1,000. Here what is being exchanged here? Cash goes out and laptop comes in. This is the exchange in this transaction. What accounts are affected? You see liabilities? No, because the cash is not a liability and laptop is not a liability. Capital is also not asset. Cash is generally an asset and laptop is also an asset. So this account is affected. Incomes. In this transaction there is no income generated. So not. Expense. This is also not. Which of the account is increasing or decreasing? Cash account. As cash decreases and laptop increases. Are the amounts debits or credits? We already know that increase in asset is debited and decrease in asset is credited. I told this is the main rule to be followed to make the transactions easy. Laptop account is debited as it increases and cash account is credited as asset is decreasing. Thanks for watching.